So let's talk about this is my observation: 10 mistakes beginner traders commit and repeat. And this is my observation, folks. Most novice traders fall for these negative points. And according to my own experiences, I can say that many advanced traders or so-called advanced traders will commit the same mistakes daily. Advanced traders, what I mean is experience, like more they have spent time more time in trading, like they've been trading for years. They not necessarily advanced traders, they could be just advanced, you know in terms of what they think they're advanced. However, this is not nothing personal. It's just an observation. I tried to gather all these mistakes within 10 points. Some might seem more damaging and more important, but to me, they all are as bad. They all bad equally. If you're a beginner, advanced, or even somebody who's been doing well, there's no harm in learning more. So let's start. Let's see what's going on. First mistake that I think is important is avoiding real education and lack of a clear strategy. This is where a lot of people try and save money. And again, this is not something that, I'm not asking anybody to join any specific education, because everybody has a different mentality on what education should be. But investing in education, folks, meaning that you have a strategy. Of course, when you invest in an education, first of all, you have to look at your personality versus this strategy, and you have to get a trial, see if it works. Try and see the educator or the people or the company. Are they reputable? What is their support level? Are they supportive? Are you buying just indicators? Are you buying their time? Are they open to your questions if you have any questions? So there's a lot of things involved. However, even if you don't want to start with paid education, there is a lot to know on the internet. You cannot just download a platform and go open an account and start trading without knowing what's going on. Now, I would say 90% of the knowledge out there is not useful. It's actually designed to actually make you follow certain strategies that actually not beneficial. They will make you reject the whole idea. So make sure that you understand and do your homework initially, and also try and get into these educational programs for a trial or for free, or ask questions. Make sure that the company is giving you good education, and that will save you a lot. Imagine, let's say for example, you're paying $1,000 for education, right? And this education will help you build yourself in terms of becoming a good trader. That will help you avoid a lot of mistakes in the future. Each mistake will cost you maybe more than $1,000. So you are basically investing it just by avoiding certain mistakes. You are making the money back. That's an investment. That's a good investment. Okay, so that is one of the mistakes that people will do, or novice traders will do. Try and save money on the education. I'm not saying you go buy a $50,000 education if it doesn't make sense. No, the price is not the issue. Some education is cheap in terms of price, but very valuable in terms of a material, right? So you have to make sure, you have to ask questions. If you have traders, friends that are sincere, then ask them. Make sense? Second, uh, must trade regardless on what market makers are doing or the timing of the market. And this is a very, very important subject. Why? A lot of traders will think that trading is a hobby, and they will think they need to trade a certain hours and spend the rest of the day or the week off. It doesn't work like that. That only happens in commercials. So if you are trading, if you are thinking that you have maybe 2 hours a day from let's say 8 a.m. to 10 a.m., and that's what how much time you're going to spend trading, automatically that will translate into you taking trades that don't make sense. You will not last more than a few days in this business because it doesn't make sense. You are forcing the market, you're forcing to trade markets that are not there, or moves that are not there, just because you have time, 2 hours a day. If you only have 2 hours a day and you wanna trade in these 2 hours, first of all, you have to learn. Second, try and understand which markets in these 2 hours are logical and moving, and then try and take your time with them. Market makers are behind every single move. It's not you, it's not me. We are trying to understand their mentality. We are trying to understand what they're doing. So it's not according to you what the market is doing. You have just to follow the logic behind these moves, right? So you don't have to trade whenever you're available. That's not a good thing to do. Okay. Number three, random trading. Um, Random trading. What is random trading? It's very simple. You think the market is going to go up. You just, the market went up. You take a trade. Um, let's see some examples. Very simple. Let me look at the other examples actually. Um, Random trading. Some of people, they do reversal trades. Some people, they would do continuation trades. So market goes up, for example here. um, Market goes up here. You think, you know what, this is a long, and by the time you decide to go long, it's reversing. You don't know why this happened. You don't know why the market get trapped you have no idea. Some people are continuation traders. They automatically, they're programmed to do continuation trading. Random trading, basically, without knowing why, the reason. They don't have a strategy. They don't anticipate the market. So some people are reversal traders. They like to go against every single move. They think the market goes um, up. Oh, good, let's go against it because it went up. Because they learned every move has a retracement and it'll continue down. No, it doesn't work like that. You have to anticipate the market. You have to know what the market is doing. Random trading is not trading. Random trading is gambling. So basically, you are thinking in your mind that, not you, don't take it personal, but a lot of traders think, what the worst that can happen? This is 50-50. Like anything, this is 50-50. If I buy, the market could go up according to what I'm doing, or it could go down. So it's 50-50. They don't understand. There's no such thing as 50-50 in trading. No such thing. It's uh, uh, almost 80% psychological. There's no 50-50. In fact, since when was the last time you had 50-50 luck? And with 50-50 luck, a lot of times you can be a winner if you know how to manage your stops and targets. So no random trading. That goes to the first point, which is education. Whether you learn it on your own, you practice it, or you learn it with a group or a mentor. That's very important to know. No such thing as 50-50 or random trading. It's not going to help you at all. Okay. So next thing we will talk about. Let's see what's the next. Uh, Not understanding the risk and how to position the stop loss. Wow, that is very important, right? It's very, very important. Let me pause for a sec. Let me grab some examples. Okay, let's look. Any market, any trend. You're looking for the market, and you have an idea at this point that the market is going to go up, but you learned that the market's going to retrace, for example, to certain level. For example, you want it to retrace to here, to this level, and from here you're going to take it long. Now the market comes to this level. You take it long. Where is your stop loss? You have no specific idea because you don't know what's going on. Maybe you learned that the next level for a stop loss will be maybe a level that you have based on a technical indicator or something, but you don't have a stop loss. You have no idea, and not knowing the stop, it will be a problem. Why is that? Because you're not aware of rejection points at this point, the real rejection points versus continuation levels or zones. So the market goes and takes you out without knowing why. Why did it stop here? Why did it not stop here? According to where was your stop loss? And yes, it is long, but why did I take it from here? What if I knew there was a rejection in this area and my stop loss was just below it, right? You continue, but once you understand volume profile, uh, once you understand volume and how the market works, for example, this has no volume profile, but once I bring it in, not understanding, uh, you see how the market got rejected from this area and that's an example, right? That's an example. So the volume profile uh, divides the market, the moves into continuation zones, and I'm making it simple. Not This is not advanced. This is simple. Continuation zones versus rejection zones. So the black line is my continuation zone, and basically the red box here is my rejection zone. So continuation versus the rejection. Now let me put it on in a very simple way for us to understand it. Let me clear this. Right now, if I want to understand this better, not knowing, now I want to know my stop loss. So let's assume that now you know where your stop loss is, and this was a continuation zone that the market went through, and there was another continuation zone that the market went through, right? In between, you have a zone that is rejection. This area is rejection, right? So if you know this, and you have an entry for according to your level of education, and according to what you have a level of entry here, but you don't know there's continuation zone against you. Your stop loss will be here, and you get stopped out. Man, automatically you're gonna get stopped out if you do stop loss. A lot of members, not members, a lot of traders, they don't do stop losses. So, however, knowing this, having enough education, knowing that this is the real area for rejection according to the volume. Volume is key, folks. Not something I'm creating. This is what the market creates for you to see. So if you know this is the area for rejection, or this is the final point for rejection, you would know if there's an entry in this area, you will take it, and your stop loss cannot be here randomly. This is a huge stop. So instead, you will have a stop here. Why is that? Because if the market goes up, of course, most likely it'll go up in your favor because it's a true rejection, first touch, etc. This is part of the education. But if it comes back and breaks it, you need to get stopped out here on the runner if you manage your trade properly. Why do you want to leave it open? Because this whole area is going to get covered after. So not knowing the stop loss, not knowing that's a huge thing. That's a very, very crucial in your trading success. If you don't know this, how to establish your stops, and it means you don't know the exact areas for trading. Make sense? I'll give you a mathematical approach so you understand what I mean. I'll bring a calculator in, right? Let's assume with knowledge, now you know how to position your stops. So your stop losses were 30 pips in the past. Now you know how to trade with 15 pips. So you reduced 15. So now you are at 15 pips stop loss. Let's say you get stopped out on 3 contracts. Okay? So now you saved 15 pips on that stop loss. Just telling you the worst case scenario. The negative part of it will still positive. Let's say you get stopped out once a day on 3 contracts, and you saved 15 pips on that. So that's times 3 times $10. Let's say you're trading $10 a contract. Just give you so that is $450 you saved because your stop loss was randomly 30 pips. Now it's is 15 pips times, let's say, 4 days a week. You trade 4 days a week times, let's say, not 52 weeks, 40 weeks. You trade 40 weeks. That's $72,000 just from the fact that you're understanding stop losses and the positioning of it better than before. Okay, so that's crucial. Saving $72,000, and that's an example. If you're trading mini contracts, or well, that's $7,200, for example. Can't anticipate. Don't know how to anticipate the markets. Goes back to the same thing, same idea. If a lot of people will do Fibonacci's, will do different instruments. Yes, that's good. As long as you anticipate the market's move, you don't fall into continuation. You don't fall into random trading just because the market is going up and up. It doesn't mean that it's going to go up. Maybe it hit a wall, right? So maybe this is the case with the market. The market is going up, is going up, is going up. You're thinking it's going to continue up, like so you wait for it to retrace down and take it back up again, not knowing that from a different picture, a bigger picture, this area that touched it, it's a complete reversal area. So you're not anticipating that this should be your exit. You cannot keep going. You don't know. You don't anticipate the market. You don't see the big picture. Let's see if we have examples on that. Okay. This is a fair example, I would say. You're anticipating that this instrument, the US 30 or the Dow, because it's going up, and then there's a flag happening. You think it's going to burst back up, and just you don't anticipate. You think it's going to go up. But if you look at a deeper level, you see where the market is bouncing from, and you have to pay attention to how many times it bounced from. Also pay attention to the most recent trend, which is, you see kind of lower lows happening. So why would you think it's going to go higher, although this neutral at this time? And there's a possibility that there's a possibility that's going to break down. So if you know this level, you would anticipate better. You would say, okay, I have the level here. If it goes below this level, then basically I would look for short. For now, I would leave it alone. Not get in. Even if I get in long, how many times this area touched. So where is my stop loss? It touched here multiple times. When you have an area that's been touched over and over and over, it means it's weak. You cannot choose it for a stop loss. It's a bad decision. Okay. Simply, when we look at the markets, we have, sorry, not this. When we look at the markets, we have zones. This is continuation, and in the middle we have, as I mentioned, for example, rejection zone. So if I want to have a trade, for example, it bounced from here, then it went up, then broke this level. Now my next level is to anticipate the continuation all the way here. So if you know how to anticipate, there's a continuation. So if we went inside this continuation zone, see continuation, this is our rejection. Why would I try and go long here? So I have to anticipate according to the logic. So if you don't know how to anticipate is important. Anticipation is important, because now we're going to talk about confirmation and then execution. Back. So next we have lack of confirmation. And this is something that also as important, if not extremely important. So we talked about anticipation. Now we'll talk about, this is, we said anticipation. The methodology is anticipate, confirm, execute. So the methodology is ACE, but confirmation is key. Remember on the NASDAQ, for example, let's say we're looking for this on the NASDAQ, NAS 100 or NASDAQ, even NAS 100, right? We're looking for a move, let's say, to this level, for example. And from this move, let's assume that we have a long. Now, in this level, when we get to this level, when we get to this level for a long, what is it there that will give us that comfort? What will make us confirm the trade? What do we have here? Um, is there anything that will, just because it's a level that we determined from Fibonacci or RSI or any indicator that you're using, um, moving averages, MACD, just because you have a level here to go long? What is the confirmation? What will make you feel more comfortable that there are other reasons besides one? So confirmation basically boils down into understanding or gathering as much information as you can to confirm a certain trade. Of course, we do have certain indicators. We have the power lines, we have the volume profile, which will give you, levels of, for example, one of them will be continuation, and there's another continuation, and in the between there's rejection. But even then, that's not enough. You have to see price action. You have to see what the market is intending. Are you the person who would wait for the market to touch your level, bounce up, and start making higher highs? Or do you think that that's going to make you lose a crucial amount of profit before it goes up? So you have to gather all this information. A lot of people use multiple different indicators that would show up at the same level for confirmation. So confirmation is key to your trading. As the more solid and good indicators you have to help you, the better. One of the main things that people would use, for example, in this case, we have you see this level on the volume profile, and this is also a mistake even for the advanced traders. They use this level for confirmation. No, this level is for anticipation. The confirmation comes after we touch this level. What the price is doing, what other things we have to help us out. Am I going to go randomly long just because it's a rejection zone? So no, there is also confirmation. So confirmation is key, right? Um, Look into it, gather. For example, I have these power lines are very good for confirmation. They help me understand that if I have a power line touching, so if the market touches here and I have a power line touching it, I might use it. Why not? I can plot my power lines into daily, weekly, hourly, minute chart. So I can go as small as a minute chart if I want to, or 987 tick chart. I can use the arrows. We have other indicators. Let's see. Let's look. Maybe you can see them in some other. Where are the arrows? Maybe in some other. Uh, you see the arrows here. They might help. DRL could help a lot. So, there is a need for confirming your trade. That is very important. Point number 7 is avoiding diversifying and focusing on one market only. It's very, very common where people fall in love with one instrument. If you fall in love with the instrument, one instrument, you better pay attention to the times that it moves, and don't fall into the second. Remember this, I think the second or third slide we talked about the timing, or you have to trade, because once you focus on just one instrument, automatically you will be wanting to trade just one instrument according to your time, which is very bad. It lack of opportunities in that instrument will force you to make mistakes, will force you to take trades that are not needed, or creating trades that are not there, folks. If you focus, let's say, only on crude, and there's nothing going on crude, for example, for a while, right? This will force you to just sit there and then fall into trades that are not there. When I have a level, and this is what I do, and this is what I try and teach my members. For example, I have a level on crude to trade, and the level is, for example, here. I don't have anything here at this point. The worst thing I'm looking for is the crude goes up to this level, and I want to short it from this level. So I'm looking for either a short from this price, for example, and this is part of the anticipation, not confirmation. I'm looking for the market to go up and then short to this level. Or if I don't have this, I'm looking for a long. If it comes back down here, I'm looking for a long from this level, from the bottom level. Now, if you're trading one instrument, this might take a few days. If you're trading just the crude. Meanwhile, you don't know. You're not paying attention. You might take trades that don't mean anything. So having this indicator, for example, these lines will give you an audio. So if you have multiple instruments, you don't have to miss this, but you can look at other instruments. I'm looking at the ES, the NASDAQ, the RTY, the nat gas, the gold, the silver, the yen, the Aussie, the CAD. I look at a lot of things and I mark them. I put my lines on the levels that I want to trade. And when the market touches these lines, I will automatically hear it in my ear because it's one of the indicators that we use, and I will flip to that. So diversifying your trading or your instruments is crucial. It's very important. It will make your time more valuable. It will make it you will be more effective in using your time while you're trading. No stress, because if it's not there, you look at a different instrument. If you don't have something that valid that you see, you flip to another instrument. Make sense? Let's go back and see what's next. Trading according to the media news without understanding market makers' intentions. And this is also something very exciting to talk about. Why? Because believe it or not, and I've been doing this for a very long time. Some very long time. Some of you know this. Media's news is designed for you to have a specific understanding and specific direction in the market. And sure enough, that's not the case when you actually take the trade or get into that trade. Because media is controlled by certain people, and these people are market makers themselves. Believe it or not, that's the case, right? So trade what you see, not what you feel. You know, when was it when COVID started? A few months after, there was a lot of people in the on TikTok, and the wives would listen to it, your best friends would listen to it, and they will nag you, buy gold, buy gold, buy gold, because everybody's talking about gold, the media is talking about gold, dollar is gonna go to crap, and what happened to gold? It actually went down. You know how many people lost their shirts? I mean, it is the media that will push these agendas that you don't know, and that's one of them. The other thing is the news announcements. I showed you first thing in this. I showed you news announcements. This news announcement, if you don't understand them clearly, even if you do, it's so tough to trade these, folks. Like this GDP came out uh, last. Uh, no, this no. For now, today, what do we have? Consumer confidence came out. Let me see what happened here today, just now. Consumer confidence came out negative. What happened to the market? I mean, when the news came out, I was watching. The Nasdaq went up. Maybe you were selling the Nasdaq because the news came out negative. Here, new home sales came out positive, yet the previous was revised negative. So not only canceling each other out, it's just confusing. Okay, so don't try unless which is illegal to do insider trading. That's not news. That's actually knowing you are moving the market. You don't pay attention to the media. Okay, when it comes to trading. Trade management, skills or discipline. Trade management. Remember we talked about anticipate, confirm. Let's talk about the E part, execute, trade management. How often have you taken a trade where it was positive, like logically speaking, after the fact you notice it went in your favor, but you lost money on that trade? Just tell me. Think about it. So many times. Why? Because every time you trade, again, don't take it personal, it's not you, this is general. Every time you trade, you want to trade short from here, you want a home run, you want 500,000 ticks because maybe you had a couple of losses prior to this. You want 500,000 ticks. Okay, you grab your 500,000 ticks, but at least manage it when you start the trade, manage it correctly. At least if you trade, let's say, with two contracts, when the market goes in your favor and you have a stop loss here, take enough on the first target to cover the stop loss at least. At least do that. And that's the basic thing you do, right? And if, when your runner goes all the way down and you're making money, and logically you know there's a support area and the timing of the day might bring it back up, maybe 10:30 a.m. Eastern. That usually reversals if they happen. Uh, at least move your stop loss and lock in profits. And if the market goes against you and all of a sudden you are at break even, why do you want to keep it goes, why do you want to keep hoping? So praying, wishing don't work. You have to know how to manage your trades and be disciplined, right? Again, this is not a hobby. This is a business. Okay? Let's go and look at the last slide. Hopefully, lack of patience and ignoring the psychological tension. I'm hoping to actually make a video on this, or actually at least uh, uh, release the video that we had in 2014 by Dr. Kenneth Reed, Adult ADD and How It Manifests Itself in Trading. Folks, I urge you, if you want to be a little bit more stable and successful in trading, I want you to look at a few things that might be beneficial to you. Just a second. I just did a quick search. Sorry, not this. I want to bring this down. I just did a quick search and see what I got in terms of results. Um, Please do yourself a favor and look at these. 90% of the issues that you would encounter throughout your trading career are within these parameters. It is you would not only understand why you do certain things, right? Look into adult ADD and how it affects traders. Uh, but it also it will affect these things will affect your psychology within your daily life, right? You'll understand why is your room cluttered, or why your desk is all messed up, or sometimes extremely neat, but you are bad in keeping appointments, or you know um, a lot of things that will come in play that also part of your trading habits. uh, why can't you wait for a level to hit before you trade it? Why are you rushing into it? Why do you assume that it's not gonna come to your level? Why do you trade where you know you have a 50 pip stop loss or wide stop, and then when you take it, you regret it because it came to a better entry level? So all these things are important, and look into adult ADD and how it affects traders, day traders, or even swing traders, whatever, and that will help you a lot understanding. Any questions? And hopefully I did a good job in presenting this video, because it's very important, although it's basics, but we need to be reminded of these things almost on a weekly or monthly basis. Thank you.